Welcome to today's market report.
European stocks scaled new highs on Monday on broad-based gains, but worries about the pace of economic recovery made defensive sectors the best bid, while travel stocks slumped with the Delta variant of coronavirus becoming dominant. The Pan-European Stock 600 index rose 0.7% and hit 461.10, extending gains from Friday after a tumultuous week. Germany's DAX also briefly touched a new high of 15,806.9 before closing just below that level. Real estate, utilities and healthcare were among the biggest gaining sectors, up between 1.4% and 1.6%. Travel and leisure dropped 1.3%, with British Airlines leading losses. The World Health Organization said on Monday the infectious Delta variant was becoming dominant, and many countries had yet to receive enough vaccine doses to protect their health workers. But England was still set to lift COVID-19 curbs next week. London stocks lagged European peers as declines in travel stocks were accompanied by a slide in energy and material stocks as oil and copper prices fell on economic worries. Volatility picked up across global markets last week after US and China data raised fears that economic growth might have peaked, driving government bond prices higher and stocks lower. The sharp decline in bond yields over the past week has not yet been reflected in stock markets or commodities. Focus this week will also be on a bunch of economic reports, including headline US inflation data and retail sales, as well as US Federal Reserve Chair Jerome Powell's testimony before Congress on Wednesday and Thursday on inflation and the timing for tapering. The S&P hit a record high on Monday, lifted by Tesla and bank stocks, as investors awaited the start of the second quarter earnings season and a batch of economic data. The Nasdaq also hit an all-time high before receding into negative territory. Tesla jumped 3.6%. The CEO Elon Musk insisted in court on Monday he does not control Tesla and said he did not enjoy being the electric vehicle company's chief executive as he took the stand to defend the company's 2016 acquisition of SolarCity. JPMorgan Chase added almost 2%, and the two shares contributed more to the S&P 500's gains than any other stocks. Investors will closely watch quarterly reports for early clues on how long the US economic recovery may last, with June quarter earnings per share for S&P 500 companies expected to rise 66%, according to IBES data from Refinitiv. The benchmark index SPX has rallied 16% so far this year, with some investors questioning how long the rally may last and concerned about a potential downturn. Earnings season is going to be warmly greeted as an opportunity for existing biases to be confirmed. Even if forecasts are not as rosy as what the most bullish had hoped, it is all going to get rationalized away. Focus this week will be also on a series of economic reports. Investors have been concerned about higher inflation and the spread of the Delta variant in the past few sessions, with traders seesawing between economy-linked value stocks and tech-heavy growth names. Crude oil WTI was down 0.42% at $74.25 per barrel. Brent oil was down 0.26% at $75.35 per barrel. Gold futures was down 0.21% at $1,806.75 per ounce. On the FX front, the GBP-USD pair will trade at 139 during the third quarter and also at 139 by the first quarter of 2022, according to the forecast of analysts at CIBC. They pointed out the market will be forced to consider earlier than expected action from the Bank of England, supporting the GBP-USD pair. The pair is currently trading around the 138.40 region and struggled to capitalize on Friday's strong rally of over 150 pips and find acceptance above the 138.30. A steady increase in COVID-19 cases and related hospitalizations in Britain might have jeopardized the UK government's plan to end most of coronavirus restrictions on 19th of July. The euro-dollar keeps capped near 118.80, whilst the dollar index was up 0.1% at 92.267, near a 3-month high.
This is today's market news. Thanks for listening. We'll see you next time.